Okay, we're ready to get started. So good morning. My name is Tim Gonzalez. I'm a financial advisor here at PKS Investment Advisors. And also let me introduce Gigi.
Hi, everybody. Gigi Lakites here, a financial advisor as well at PKS Investment Advisors.
And we're very excited to be able to bring you this webinar event where we can hear from Dr. Apollo Lupescu from Dimensional Funds. Let me go ahead and get started with some of the housekeeping, and I'm just going to go ahead and read it. So in this webinar format, all participants will be muted and attendees' video is off for privacy, so don't worry, no one's going to be looking at you. We encourage questions through the Q&A box. Not the chat box, but there's a Q&A box right in the middle there. On the box should be in the bottom middle or the top middle of your Zoom screen, Zoom window. Only panelists and hosts can see the questions for your privacy. And questions that we can't get to answer directly during this webinar, we'll connect afterwards, after the webinar, we can address them individually with you. So we, PKS Investment Advisors, we're a registered investment advisor. We manage a little over $230 million of assets. And we've been in business for a little over 20 years. We're, of course, affiliated with PKS and Company, the CPA practice, which has been in business for well over 40 years. We specialize in investment management and financial planning. So with all that, I would like to go ahead and introduce our speaker. I'm going to thank, there he is, look at that, Dr. Apollo Lupescu. I'm going to go ahead and read the bio. It's Apollo Lupescu is a vice president of Dimensional Fund Advisors, and Dimensional Funds is one of the premier investment managers in the world, managing over $600 billion in assets. And Dimensional Funds is one of the companies that we partner with. It helps us with our portfolios and help us bring value to our clients. Apollo is a nationally and internationally recognized speaker who's delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. He's considered the secretary of explaining stuff because he excels at delivering thought-provoking presentations in a clear and understandable way. Apollo has been with Dimensional in Santa Monica for 17 years. Prior to that, he taught at the University of California, received his PhD from UC Santa Barbara, and also holds a BA in economics from Michigan State University, where he competed and coached water polo. Apparently, rumor has it he is still an avid player, and however, during the pandemic, he's recently picked up surfing. Of course, I was in Santa Monica, and I think by law you have to do that. But without further ado, go ahead, Apollo. Tell us, say hello.
Well, good morning, Tim. Good morning, Gigi. Thank you so much. And you know, it's kind of harder because the older you get, you know, like your mind wants to do things, but your body's kind of like, yeah, I don't know about that.
Yes, I've heard of this.
We've heard of that, yeah.
So, Gigi, you want to get us started?
Yeah, I'm going to go ahead and kick off the questions. And so we'll start with this investment question. To use a technical term, Apollo, 2020 was a crazy year, from the pandemic to the polarized election and its unusual aftermath. Let's start with a brief review of the market performance and how stocks reacted to all these events. Is there something that jumped out at you? Any big lessons or insights that might be useful for investors going forward?
Yeah, well, I think it's a really important place to start, not just to review what happened, because, you know, to some degree, we know it's not, as you said, a crazy year, but what is it important about it to learn that would help investors going forward? You know, come to think about it, one of the thing that jumped at me is just how unpredictable the market can be and how important it is for an investor not to try to create some sort of forecast that even if it might seem obvious, it might not necessarily lead to the right conclusion. And what I mean by that, you know, Gigi and Tim, if we had a fairy godmother and that person told us at the beginning of the year that we will have this pandemic going on, I think a lot of us, myself included, if I had known exactly that the economy would be shut down, that hundreds of thousands of people would die in the US from this disease, I think the natural reaction might have been to, let's say, sell out of the market and get out of the market because it seems like obviously it's going to be really bad. And for a while, that's what it looked like. When you look at the market, the way it started for the first few 3 months or so in the US, the broad market considered to be, in this case, the S&P 500, which is a collection of the largest 500 companies in the US stock market, after it started the year in a pretty benign way, it had a huge steep drop that over the course of about 5 weeks, it lost about a third of its value. And this is incredibly steep. It rarely happens this fast. In the entire 2008, when we had the financial downturn, the market lost roughly the same amount, the same percentage over the entire course of the year. We accomplished that in 5 weeks. So at that point, for a lot of investors, it seemed like this is really scary. We see what's ahead. It cannot be good. And we certainly want to maybe protect ourselves. And a lot of folks actually took some action on this, and we'll come back to this. But what's incredible is that as we got down in the pandemic, what happened afterwards was completely unexpected. Even as the shutdowns, the lockdowns were being put in place, the market staged an incredible rebound. By the beginning of the summer, by about this time last year, the market had recovered the losses and broken even for the year. And you heard a lot about the V-shaped recovery. Well, that's what the V-shape meant, is a very steep drop, but a very steep recovery as well. That's what the V-shape, if you remember those terms that we heard last year. And then from then on, it went on to become more like a Nike swoosh, because it continued to go up. And for the year in 2020, the market was actually up about 18%. Which is almost twice as much as the historical average. So we had an incredible experience last year, because throughout all this, the market surprised everyone. If I had known exactly play by play what would happen in the economy with the virus, I think a lot of folks would have sold. And even if you know exactly what would have happened, you would have made the wrong decision, because ultimately the market was up and up quite significantly for the year. And the thing is that's one of the big lessons. Even if you think you might know what's going to happen, that doesn't always translate into the right investment decision. The second big thing that came out of that was this idea that when the market started dropping, what you saw, a lot of people were paying attention not just to the U.S. but the global markets. And as you see here, these bars represent the performance of global stock markets, and we see here that month after month we had some very negative returns in the market. And what happened was, as these returns were taking place, a lot of folks were acting on emotions, and what they were doing is they were selling from whatever holdings they had, and they were buying into these money market funds. So what you see here is money that went from whatever investments into the safety of the money market fund, which tends to be equivalent to cash. And what you saw at the beginning of the year, there is not much movement. People were kind of holding steady. But as the market dropped, a lot of folks starting to sell, and you saw these inflows into these money market funds. And this is in billions. So this year is $1 trillion of investor money that went into money market funds, because people were scared, and it was normal to be scared. There's no doubt. It was the natural emotion to have. The problem was that as the market started to rebound, and you had month after month after month after month after month of positive market returns, and the market rebounded, a lot of these folks who did not have a financial advisor like Gigi and Tim basically were still in cash. And the problem is that they missed the recovery. I heard this over and over again last year towards the end of the year. When should I get back in the market? By the time it was too late, a lot of these folks were still holding on to cash, not knowing when to get back in the market. And that lies the second big lesson, is that the importance of working with a financial advisor who has a consistent, disciplined approach to investing, and acknowledges the emotions, but doesn't actually trade, doesn't make decisions based on emotions, but rather much more on that disciplined, consistent approach. So to me, those are two big lessons that I thought were just so interesting to see in what happened last year.
Perfect. Thank you. All right. Second question we're going for is, in response to the pandemic, it caused a steep decline in economic activity and high unemployment rate. The government has deployed significant stimulus programs, but possibly more to come. What has been the impact of these stimulus programs on the market and the economy? And could these actions create risks down the road? Is it possible they might lead to inflation or even unsustainable levels of national debt?
Yeah, absolutely. And we heard a lot about, and there are a few questions there. So I think it's a really, again, a very timely question. Let's look at the government stimulus. Did that make sense? What did it accomplish? The second, let's look at the risk of not being able to repay the debt. And the third is the big one right now is inflation. So let's look at each one of these. The first one on the stimulus, as an economist, the stimulus to me it wasn't anybody's plan A. But the stimulus really is something that we know from economic theory, from past situations, could actually help backstop and put a plug into a situation that can really snowball into something a lot worse. And what I mean by that, let's just make it real. So last year when the lockdowns were happening, let's say there was a family there with a couple of kids in Ocean City, and maybe on Wednesday night, the parents were getting the kids a pizza, and because they didn't go to work and didn't have an income, they could not have bought the pizza. The thing is that when that happens, it's not just that the kids are unhappy and they're crying and the parents are miserable, but also the local pizza shop it doesn't have the revenue. And because they don't get the revenue, they cannot pay the employees. So the employees cannot go buy shoes or whatever else they might be buying. At the same time, they're not buying the flour and the meats and everything else that goes into making the pizza. So it really snowballs into something bigger, because then the farmers are not buying something else. So once you have a situation like this, what we know historically is that you need to put that backstop, because otherwise it could become a lot worse. So what the stimulus was intended to do is really prevent this from being something a lot worse. And when the stimulus money came, it did help the households, because the parents had some money to buy the kids some pizza, and that was good for the entire family. But it also helped Main Street businesses, small businesses, because that pizza shop now had some revenue and can, go through the pandemic. But at the same time, absolutely, it also helped the stock market, because part of the stimulus was spent on large companies that are part of the stock market, and that, again, that was part of the reason that we saw the market going up last year. So stimulus, without a doubt, it did help households, small businesses, as well as the stock market. Now, was every dollar spent wisely? Or I'm not going to get into that, but the idea of the stimulus was something that was necessary, as much as a lot of people didn't like it. Nobody really likes spending money like that. But given the situation that we're in, it was a better alternative than not doing anything. Now, what about the second question, is the ability of the government to repay the loans? And that's really important. Well, to think about the ability to repay, there are two ways to think about it. The first one is that when the government spends money, it has somehow the ability to always refinance the debt. So, if a bond, which is a form in which the government borrows money, it just basically asks investors, listen, I'd like to borrow some money. If you give me $1,000, for example, I will pay you interest for a number of years. And at the back end, I will also repay the principal. And the thing is that the principal, you can kind of push it back. When a bond is due, you issue another one, so you can push back. But the big cost that cannot really be moved around is the interest payments. So you have to make interest payments to investors who bought these bonds. And what's interesting is that the level of the debt, in other words, how much we owe, has gone up incredibly. Just a lot has been going up over the last few years. And that's disconcerting to a lot of folks, the level of debt. But again, another metric that I think is really important, and I'll give you two metrics to kind of look at this issue perhaps through a different lens. The first one is, what is the level of the interest payments relative to the size of the economy. So in other words, how much does it cost us as a society to make these interest payments? Because that is actually a very relevant metric. The more it costs us as a society, the greater the cost, well, the bigger the burden that this debt places on us. And there is a way, and I can share with Gigi and Tim this website that we can all go look at this metric, which is the fraction of the economy, the economic output every year that goes into repaying paying the interest on this debt, and that is published by the Federal Reserve of St. Louis. And that basically this is a live web page that I'm showing you right now that looks at this interest as percent of the GDP, gross domestic product, which is the value of all goods and services in the US. And when you look at the historical values, what you see is that for a long time, it was about 1.5% or so. And then in the 1980s and in the early 90s, it skyrocketed at almost 3% or almost 3.2% of the value of the economy, of the economic output went into paying interest on the debt. So even though the debt level was a lot lower, we didn't owe as much money. Clearly, the high interest rates at the time made this a lot more burdensome than it is today. Because today, because of these interest rates, even though the level of the debt itself is very high, these low interest rates are actually making this a lot more manageable to service the debt than even in the early 90s. So in that respect, clearly there was a higher burden of the debt, even though we didn't owe as much money. We owed a fraction of what we owe today. But because the interest rates are so much higher on the government debt, made a huge difference. So yes, it is bad today, the level of debt, no doubt. It's gone up and up and up. But it seems like the saving grace here, the thing that's making this manageable is the fact that the interest rates are so low. So as a country, we're paying almost half in terms of the burden on us as a country as we did in the early 90s. And there is another way. So that's the first metric to look and see how burdensome is this debt on us. But the other one which is really important, is to look at how much does it cost the government to borrow money. Because that's the interest that we're talking about, is how much does it cost you to borrow money? And it turns out that the government it cannot force us. It cannot force us as an investment manager. It cannot force you as an investor to give money. That used to be the case way back, 400 years ago in France and other European countries, when a king can force people to lend them money. That's not the case today. It has to be a voluntary transaction. So if I am a lender, if I'm an investor, I would like to get as much on my money as possible. If I'm the government, I want to pay as little as possible in interest. So there's a happy place where, there's something called an equilibrium interest rate, which is the interest rate that you see in the market that makes both the investors and the government happy. And if you look right now, and this is as of a couple months ago, 3 months ago, what you see is that the interest rate was about 1.4. It's roughly the same today, not vastly different today. But what's interesting is that the US government is competing for this money with other companies. And Amazon, for example, would also like to borrow money through these bonds. And Amazon would love to pay as little as possible. But this market is basically saying, part of what I'm evaluating here is what's the relative riskiness? Are you a good bet that you're going to pay back what you promise? And even Amazon, that has a very good reputation, it's a large company, when they want to borrow money, they have to pay 1.9, so quite significantly more than the US government. So when you look on what investors are evaluating in terms of their perceived notion of the ability to repay, even Amazon doesn't hold a candle to the government. And then you have, as an example, Coca-Cola. Coca-Cola has to pay more to investors than Amazon. Again, it's all in the evaluation of what is the perceived ability to repay the principal and the interest. And you go beyond that to Ford, that's a little bit higher. In other countries, when they want to borrow from us, for example, Turkey pays over 5.5% in interest. and Macy's, the department store, over 7%. In other words, what you want to see out there, if you're interested in knowing what's the market, what are investors thinking in terms of the ability to repay, well, that is saying right now, the signal is that, look, the U.S. is certainly on a pretty good risk spectrum relative to everything else out there. And what we want to pay attention is, what if the interest rates on U.S. government bonds starts jumping perhaps higher than Amazon? Well, at that point, the signal is that the U.S. has more risk than Amazon. And does this happen? It hasn't not happened to the U.S., but it happened to other governments. There was about 10, 12 years ago, the U.S. and the Greek government bonds were paying pretty much the same exact interest rate. But then the creditors got a hold of the fact that the Greek government might not have the resources to pay its loans and to pay back the bonds. And what happens is they jump. The U.S. stayed the same, but the interest rate on those Greek bonds skyrocketed. And that was a signal that we think there's more risk associated with all the loans that they're taking, which is not happening right now with the U.S. bonds. So the market, when it's evaluating everything, it's kind of saying, yeah, it's a big debt, but because the rates are so low and because the U.S. has always managed to pay its loan, the interest rate doesn't reflect the additional risk that we all might be fearing out there. And the last question on inflation, boy, so we talked about the stimulus, we talked about the federal debt, and the third one on inflation. Listen, I think a lot of us are concerned about all the money the government's spending and thinking that somehow that might translate into some big inflation. And inflation is a boogeyman word because you hear so much about it in a negative context. Well, let me tell you, folks, inflation has been part of the economy. And not only that it's not unusual, but inflation is actually desirable. Why? Because inflation means that prices go up from year to year. So if you bought a pair of speakers for $100 last year, this year, based on the long-term trend of about 3% increase per year, it would cost $103. Is that something bad? Not at all. It is desirable because these companies are borrowing money. They have to pay interest. And the fact that the prices go up, it allows them to pay back some of these loans and actually continue to increase profits. And if we don't have that, and that's exactly what happened in the Great Depression, the prices went down. Well, you have to produce a lot more just to keep up with your debts. So again, price increases is not unusual. It's actually desirable. The Federal Reserve has put a target of about 2% per year as desired inflation. So this idea that if you're in the 2 to 3% range, it's not only unusual, but it's actually desirable. So let's just get this straight. 2 to 3% inflation, it is not something that we should be scared about, but we should want that. Japan has been dreaming of this for years and years, and they're not getting there. They're having a lot of troubles with this. So with that setting the stage, is it possible that when we have all this money put in the economy through the government spending, that would lead to somehow much greater inflation? The first answer to that is that, well, the experience that we had with the last time that we did this, which is the financial crisis, it's kind of telling a different story. When we had the financial crisis 12 years ago, the Federal Reserve put in place a program called quantitative easing. And that's a program that again, deployed a lot of dollar bills in the economy. In fact, between 2009 and 2014, the Federal Reserve put in the economy about $4.5 trillion with a T, a lot of money. And we had similar questions back then. Well, surely all this money will lead to runaway inflation. Dollar's going to lose its value. It's going to be horrific. Well, what happened since then? Well, since that quantitative easing was put in place, the average inflation in the U.S. has been roughly about 1.5%. 1.5%, half the historical average, and even below the Fed's target, even though we had so much being put in the economy. So why is that? Because it seems counterintuitive. And what are the lessons for today? Well, the reason is that inflation is not just about how much money exists and that's called the demand side, but also what is the economy's ability to produce. And that's called the supply side. And what we saw is that over this period, the economy had the ability to produce, had the capacity to produce, even as demand might have increased with the additional dollar bills, and that was good for everyone. So again, it doesn't have to mean that the government spending money, the Fed spending money, creating money, it's necessarily leading to inflation. It's possible, but not necessarily. Now, what are the lessons for today? Well, you just saw a big, spike in inflation numbers yesterday. There was a report saying that the inflation went up about 5.5% or so, whatever, from last year. Well, what's interesting is that when you hear those numbers, you have to put in context. The prices last year were so low that, of course, they're going to look high today. They're probably still below pre-pandemic levels, but it's relative to last year. They're certainly going to look high. But it's interesting because this whole inflation right now is not driven necessarily by the stimulus money, but much more by the supply side. When you look at the inflation numbers, a third of the big increase that you saw yesterday, a third of that increase that everybody, quoted on the news last night, a full third is because of the jump in the price of used cars. And the reason for that has nothing to do with the stimulus, but the fact there is a global shortage of chips. So car companies have made the cars, they're sitting out there in lots, but they cannot sell them until they pop in that chip. And that chip's going to come as some of these supply bottlenecks are being resolved, but it might take a month or 2 or 3. So right now, you don't have a lot of cars, so that's why the price goes up. But picture, January, February, when all these cars that are made and they're sitting there waiting for the chip. Once the chip goes in, what do you think is going to happen to the price of cars, used cars and new cars? And I'm not telling you to go wait to buy a car, but the reality is that right now, there are some supply bottlenecks. There are some supply issues, not just in the US, but around the world, shipping. We all hear about this. And these supply situations is creating some pressure on prices, and the prices are going up, again, because of these supply issues. Now, what does it mean? Does it mean that we're going to have inflation because of these supply issues? And the reality is that at this point, we just need to, we don't know. And what it is that you have two different narratives that exist right now among investors. On one hand, people are telling, this is a transition period. We went from a pandemic world to a post-pandemic world, and there's a readjustment. The supply needs some time to get back online. There's some protocols that companies are working through. But when this is done in the short term, what you'll see is that inflation will come back down to the normal level. So that's one story that you hear out there. The second story is that, boy, maybe there's more to this. Maybe some of these high price increases are going to persist. Maybe the wages are going to go up, and that's going to be higher inflation down the road. So you have these competing narratives, one saying that inflation soon enough is going to come under control, another one saying that perhaps it won't. Well, which one should you believe? What I'm going to encourage you to think is not to look at one or the other, but rather there is a place where you can see sort of like the combined expectations, the combined opinion priced in somewhere. There's a market signal right now that we can all go look and see what is the market expecting inflation to be. And this is not, again, an opinion piece, but how investors vote with billions of dollars. And that is published once again by the Fed. And it's just a measure that's implied by the way that investors are pricing different types of bonds in the market. And that is called a break-even inflation rate, which kind of tells you, and I'm going to share with you again the live website. And the live website shows you the 5-year, for example, break-even inflation rate. So what does it mean? So before you go into the number, is the value implies what market participants expect inflation to be in the next 5 years on average. not one person or the other, but how are they voting? How are they voting with billions of dollars every day in terms of what they expect inflation to be? So if you look again from the live website, what you see is that historically over the past few years, it's been in the 1.5, even below 1.5 to 2%. But that's been the range over the last 5 years or so. And when the pandemic struck, we had an issue that was opposite. It was the idea that prices might not grow. And that was concerning by itself. But then as the economy came back to life and we had stimulus, the expected inflation in terms of what investors expect inflation to be over the next 5 years on average is about 2.4%, 2.48. That's the latest value as of Monday night. And what's interesting about this value is that it is higher, for sure it's higher than we've had the last 5 years, but it's not panic range. It's not outrageous. Yeah, it's going to be higher on average over the next 5 years, but it's certainly in the range of 2 to 3%, which is, again, something that is not really that concerning based on historical averages. So to me, yes, will we have a little bit of higher inflation? Perhaps, but it's not outrageous. And if you want to look back, and again, this chart allows you to go back as far as you want to go over the entire period, what you see is that the anomaly has been this period of being too low. But where we are today is pretty much where we were for years and years in the U.S. economy. So that's the first note. And the last thing that I'll tell you about inflation is that there is information that comes in every day about what might happen with inflation. So this line is not static, and that's what we want to keep watching it, because it changes every day as market gets new information. At some point it was, as low as 1.2, and then about in May or so it went up to 2.7, and now today is at 2.4. So it kind of changes based on the information that we have. And right now, again, much as you hear about inflation being a worrisome development, I would say that based on market signals, there's nothing really there. It's more media trying to create a sense of fear rather than anything real when it comes to inflation. So, boy, it took me a while to answer that, Tim and Gigi, but there were 3 different questions, and I thought they're all really good.
Oh, thanks, Apollo. On that same subject, we had a question come in from a viewer. National builders are putting on hold on new building starts for lack of supplies. Where will this take us? So is that also? Yeah, that's a great, and actually it's a great illustration of exactly this. When this pandemic hit last year, what happened is that a lot of businesses, and car companies being one of them, they thought that demand is going to plummet. They thought that, boy, this is going to be a terrible, nobody's going to want to buy cars. But the second thing that happened was a lot of these mills, the lumber mills, particularly in Canada, they just thought the same thing, that demand is going to plummet. So they shut down a lot of the mills. And when the realization came that, boy, people being home, they want to do home improvement, and they need lumber. At that point, what you saw is that because the supply of lumber was depressed by the lumber mills being shut down, but also the fact that in Canada, an area 4 times the size of Switzerland, in British Columbia, was impacted by the pine beetle. And all of a sudden you had that huge loss in terms of lumber. You saw the lumber prices skyrocketing. It just skyrocketed. And over the course of the last year, I think they doubled or tripled or even quadrupled in terms of the price of lumber. So that's when a lot of folks, you kind of said it, it's going to be so expensive to build. Like, why do I have to do it now? Let me hold off until some of these prices come down of lumber. And what do we see out there? Well, what you saw over the last few weeks is exactly that expectation happening. Lumber mills came back online, both in the US and in Canada. And all of a sudden, over the course of a few weeks, the price of lumber dropped by 50%. So yes, we had the big price increase because the supply was constrained. But then as the realization came and people came back to work, and apparently it takes some time to open up these lumber mills,
the price of lumber dropped by 50%, and that's exactly what some of these developers that the member of the audience might be looking at, is that they're waiting for this to happen so they can build at a lower cost, and that's exactly what's been going on. So to me, that's exactly the point: is that the market responds, both the supply and the demand, and there is an adjustment. It's going to take some time, but certainly the expectation is priced in that things are going to return to normal, and that's perhaps why some of these folks are putting things on hold. And the same, I mean, I got to tell you, I have to get a new car, whether it's new or used, and I'm holding off. I'm not telling you should do the same. In my case, I have an expectation that in the next few months, there will be the market will be flooded with new vehicles that right now are just sitting there not being able to be used, because it's very easy to pop the chip in and put the car in the lot. And in my view, I'm going to wait. If I don't have to buy right now, I'm not a motivated buyer. Why not wait a few months and wait for these prices? And that's probably what your friend or your acquaintance who is the developer might be doing.
Yeah. Thank you. So I think we'll move on to the next question. After months of solid gains, markets are hitting all-time highs, and there's a sense among some investors that it can't last forever and a drop might be right around the corner. Is this the right time to be invested in the market? And looking ahead, what can investors do to protect their portfolios from a possible market downturn, specifically folks in retirement or ones approaching retirement that really want to protect their hard-earned nest egg?
Yeah, that's such a good question. Listen, you hear all the time that with all this nuttiness, the market's hitting an all-time high. And again, I think it's understandable why people might be thinking, well, maybe I should wait for the market to drop, or should I be doing something? And the answer is, like, should you be investing in the market? I would say the answer is, it depends. I can't tell you go be invested in the market right now or not be invested in the market. And why is that? The reason for that is that when you think about the money that you have, probably the hardest thing and one of the most important things to do is to really have clarity onto what are you trying to do with your money? What are you trying to accomplish with your money? What are your financial goals? And that's what, Gigi and team were talking about, the planning aspect. The planning aspect is absolutely crucial. And the plan that you develop will inform pretty much the most important decision that you can make in investing. How much money and what percent of your assets should go in the stock market, which is about ownership in companies. And ownership in any company, it means fluctuating profits. Markets fluctuate as much as profits fluctuate. But you can also lend money, as I said, to governments and corporations in the form of bonds. So the reason I'm saying it depends is that you need to have a plan in place to figure out for your situation what percentage should go in stocks and what should go in bonds. And the experience that you get as an investor could be vastly, vastly different. And so I'm going to address that specific question about all-time highs and should you be invested in the market. But I wanted to start here is because this decision of how much money to put in the market is such an important one. And there's some big trade-offs there. If you invest in the S&P 500 over the long run, if you had invested in the S&P over the long run, what you see is that the average growth on your money on an annualized basis is about 9 to 10% per year. Real estate is about 6-7%, even in San Francisco or Los Angeles. So the stock market has delivered annualized returns that are better than even real estate, minus the headaches. But then from year to year, this is what it looks like. It's a roller coaster. It's a roller coaster. Some years you make money, some years you don't make money. So it's really, really choppy. And I'll share with you in a second how choppy it can get. In fact, I can share with you right now. If you look at the stock market and the S&P 500, how much you can chop. Well, if you look at the best 12 months and the worst 12 months, in the best 12 months in the S&P in the market, you would have made 53% in 12 months. Your money would have grown by more than 50% in 12 months. But in the worst 1 year, you would have lost about 43%. So it's incredible the variation that you can have in your money. So this idea is that it's very, very choppy to be invested in the stock market, but it's also very rewarding. We have this book that's called The Matrix book that I'm sure that Gigi and Tim are familiar with it. It's a phenomenal book of investment numbers, every investment number that you ever wanted to know. And it's funny enough, my dad is born in 1926, and had my grandparents invested $1, put it $1 in the S&P and leave it alone, by the time my dad turned 94, and he's about to be 95, that $1 would have grown to over $10,000. One single dollar increases 10,000 fold. So the stock market has been a remarkable growth engine for an investor. But again, it's like a roller coaster, and it's very, very choppy. Now, the alternative to that is to invest in these government bonds or corporate bonds. And if you look at one of the steadiest, it's a bond issued by the government. After 30 days, you get your money back plus interest. It's called the 30-day U.S. Treasury bill. And over the past 90 plus years, there has never been a single negative calendar year that you would have lost money in. Never, not a single calendar year when you open your statement and you see, oops, I have less money than the beginning of the year. And they also stayed ahead of inflation. Inflation had been about 3%. This has been 3 to 4%. So this is really the big decision that you have to make. Should I be investing in the market all-time highs? Well, the first decision is, what is your financial plan telling in terms of the balance between stocks and bonds? And the difference in growth of money is significant. But first to kind of really see the difference in I just showed you the best and worst. If you look now at the government bonds, broad government bond index over the 1 year period, yes, you had a year when you might have made 18%. That was the highest 12 months that you would have had as an investor. But the worst would have been a negative 4.5. So in other words, bad, but not nearly as bad as the stock market. And if you extend from 1 year and you go to 3 to 5 years, what you see is that over a 5 year period, there was never a single period when you would have lost money in bonds. So really, and this is a broad government bond index. And over 10 years, once again, you see that the range narrows. That what happens in stocks becomes a little bit more consistent. So instead of having a range that's so huge here between 50 plus or 43% negative, here you only go into a much narrower range. But again, for the bonds, it just really is you don't really see the negative outcomes after 10 years. So to me, the reason I'm saying all this is because you have to be very mindful of this decision. And it's also important because if you look at the growth of the same dollar over the same time period in these treasury bills, it is a whopping $22. And it's not missing any zeros. It's really only $22. So it's a very big difference between stocks and bonds. And that's why it's so important to talk about the financial plan that you have. Because some of you, when you're saying, should I be investing in the market? If you are in retirement or your risk capacity is relatively low, you might not be invested much in the market. So this whole idea of the market's all-time high, it's sort of a moot point to you. Because listen, I have a lot more money in bonds than perhaps I would have in the stock market. Now, to really answer your question now, should you be invested in an all-time high? What should you be doing when the market's hitting an all-time high? Well, the thing is that if you have that plan, when the market's running up and up and up and up, and it's going higher and higher and higher, at that point, should you be doing something? And the answer is yes, perhaps you should be doing. And what you want to consider, and what advisors do, what Gigi and Tim are doing, is basically saying, okay, so let's say that this is the right mix for you between stocks and bonds. And now the stock market's going up and up and up, and it's a greater percentage of your portfolio than it ought to be because it's gone up in value. So at that point, what you want to do is trim some of these gains, take some chips off the table, and then go buy some bonds so the portfolio comes back in alignment. that process is called rebalancing. So when the market's hitting an all-time high, that is when an advisor might consider rebalancing, because that prevents the portfolio from having too much risk. So you don't want, if you're supposed to have a 50-50 stock bond mix, you don't want to have a 70-30, because that's too much risk for your specific circumstances and preferences based on the financial plan. So when the market hits an all-time high, I think it's really important to have an advisor evaluate, is it time to rebalance? Is it time to maybe take some gains and then go buy back some bonds? Now, the thing here is that we're talking about, taking a haircut. In other words, it's a trim, not a shave. So take a little haircut so the portfolio can go back in line, but don't shave, don't sell the entire position, because the problem with selling the entire position is that if you say, well, the market's very high, it's going to drop. The problem is that, same with last year, nobody knows when to get back in the market. That's the problem. If you sell, the market's too high, it could stay high for a much, much longer time, and you miss all those returns because you don't know when to get back in the market. So to me, the answer to the question is, if you had the money to invest, the first thing is get yourself a financial plan, and that plan will tell you how much you want to have in stocks versus bonds. And then secondly, have an advisor basically rebalance the portfolio and pay attention to it. And thirdly, even if you invest the preponderance of your money in stocks, let's say that you're young and you already have a lot of real estate properties that generate steady flow, even if you have to invest in the stock market, that doesn't mean that all your money will be invested only in the Dow Jones or the S&P. Gigi and Tim can tell you more about this global perspective to investing, because if you look at a map of the world, that instead of plotting landmass, it looks at the value of all companies that can be bought and sold in any one country. This is what the world will look like. You have the US with Apple, Coca-Cola, McDonald's, you name it, Boeing, and all those companies. It represents about 57% of the value of all stocks that you can buy around the world. And the US is about 3,000 to 4,000 different companies that you can buy. But around the world, there are 40 plus other different stock markets, and there are over 10,000 different companies that you can buy around the world. So if you're an investor today in stocks, it doesn't mean that all your money would go into the US. You might have a portion of it in the US, but you might also have a global perspective. And why is it important? Maybe I'll kind of wrap it up with this, because it's not just the US companies are selling abroad, but other companies are selling to us. And why not partake in their success? I live in Los Angeles, and I remember walking not too long ago down on Westwood Boulevard, and just walking there, getting some ice cream with my kids. And at some point, I looked on the street at the variety of cars that are being parked on the street. And as I looked around, I said, well, there's certainly, American-made cars, and there's some Fords and GMs and Teslas. But on the other hand, I also saw a bunch of Mercedes and BMWs, and I thought, as an investor, if you think, oh yeah, let me hold Ford and GM, well, what's wrong with considering, BMW and Mercedes? And beyond that, you have, even American brands like Chrysler and Jeep. They're owned by a company trading in Italy. And beyond that, we know that there's a Honda and a Toyota. And we know that there's even brands like a Jaguar, Land Rover. They're owned by an Indian company. And you have to participate in India to participate in those brands. Even Volvo and Lotus, they're owned by a Chinese, or brands owned by a Chinese company, and then you have certainly the Korean company. So the point being is that you want to be globally diversified. You don't want to just put all your money in the US, because again, if it's fine to invest in Ford and GM, what's wrong with the idea of investing in BMW and Toyota? And because of that, what happens in the US market is not the dominant force onto your performance, because you have all these other companies around the world.
Very good. Thank you. Gigi, let's jump ahead. And if you'll do, I think we have time for, looks like one more question. If you want to jump ahead and do that last question you had there. You're muted.
Sorry about that. Sure. Let's go ahead and jump ahead. This is a hot topic, Apollo. We've heard quite a bit about Bitcoin, reminiscent of a few years ago when the price skyrocketed and then followed by a steep drop. What are some considerations for investors who might be curious about Bitcoin, and how should they think about Bitcoin?
Yeah, no, it's such a timely topic. So Bitcoin basically came around 2009 or so. I mean, it's been in the works for a longer time, but in 2009, there was a little paper that was published by an anonymous person who really tried to solve two problems that they were perceived to be at the time. The first one is that you have all these currencies that are being controlled by governments. And they said, well, can we have a currency that's not controlled by any one government and it just belongs to people somehow? And it's not subject to perhaps what was considered to be manipulations by the governments and so forth. And the second issue is that when you have to transfer money, right now, if I want to send somebody some money, it goes from my Venmo to the bank, to the other bank, to the other. There are all these nodes in between. And the idea was, can we streamline transactions to go from my account straight into their account without all these nodes and all these financial intermediaries? And that was the idea of creating a system that was based on a public ledger. So you have a ledger that every single transaction is written up by a set of computers that all maintain exactly the same transactions, the same ledgers. So everybody knows what everybody else owns. It's anonymous. And Bitcoin would become a currency that people would use. That was the original idea. And certainly some decent ideas in terms of making finance a little bit more streamlined. Now, if you fast forward 12 years or so, is Bitcoin a currency? Has it fulfilled its promise of being the currency? And the answer is absolutely not. Absolutely not. Why? Because if you think of a currency like dollars, what is it that makes a dollar such an important part of our life? Well, the first one as a currency is that it is a store of value. Meaning that what I can buy today is roughly the same that I could have bought a month ago, roughly the same that I can buy a month from now. That's called store of value. It is the same. Is it the same with Bitcoin? Not at all. In a few weeks, it lost 50% of the value. In other words, you could have bought half the things that you could have bought a few weeks before. So it's certainly not a store of value. It fluctuates so much in value. There's no way that's a store of value. The second thing is it's a medium of exchange, meaning that if you wanted to go buy a coffee, if you wanted to buy anything, milk, you'd be able to use that form of payment. Has any of us bought anything in Bitcoin? Not that I'm aware of. In fact, 3/4 of all transactions in Bitcoin are used for illegal activities, ransomware, kidnapping. And frankly, I really hate the notion that I would be part of a system that is used for kidnapping and ransomware. And the third one is it is a unit of account, meaning that prices are quoted in that. I know that a gallon of milk here in LA is about $4. I know how much a gallon of gas is, and it's going up, but I know how much it is. I don't know any price in Bitcoin. So because of that, it's just to clarify, Bitcoin, it is not a currency. It was intended to be a currency, but it's not. Instead, what it's become is more like a speculative investment. It's an investment. And if you think about it as an investment, how is it different than stocks and bonds? It has a huge difference from stocks and bonds. When you look at stocks and bonds, when you look at stocks, you buy ownership into a company, and the value of the ownership depends on the profits that the company makes. But I can have an expectation that the company will make money because they're real people, real profits, real products. And I have an expectation of what will I receive as a business owner, and I can value that. I can say this is how much this company is worth it based on the uncertainty of earnings, based on how much they expect to make. I can value that. When you look at bonds, the same thing. I can look at what interest payments I'll get and figure out how much it's worth today. If you buy a building, you collect rent, you figure out how much is it worth today to pay for that. In other words, all of these assets, all these investments, stocks, bonds, real estate, they can be valued because they have some cash flows that are expected to come to investors. What about Bitcoin? It has none of that. I have no idea if 60,000 is a good deal, if $60 is a good deal. I have no idea because there's nothing that I expect to get. It pays no interest. And the only reason it has value is because in my mind, somebody else will be willing to pay more for it in the future. Why? I have no idea. It is pretty much the same to me. Like I remember my girlfriend at the time was collecting Beanie Babies, and she thought, "Why I buy the Beanie Babies because somebody will pay more for them later." It's possible. It didn't work out very well for her, but that was the thing. And it's kind of the same today. Like this is like the Beanie Baby craze. It's just something that it could work out, but not necessarily. So to me, I don't look at Bitcoin as an investment. I think it's more of a speculative aspect. And some people think that, hey, listen, if I own Bitcoin, it says something about me, who I am, that I'm creative, that I'm part of the next thing. If you have that desire, to me, I would say, go ahead, buy a few Bitcoin there just for the entertainment value. If it's a substitute to a trip to Vegas during the pandemic, so be it. But I can't look right now and say that Bitcoin has a role in that financial plan. It has way too much variation in value, what's called volatility. It fluctuates in value like crazy. It's a tiny portion of the investable universe. So the entire Bitcoin universe is about 500 billion. In terms of the stock market, it's about 60 times bigger. So even if you were to own it, it would be such a tiny sliver. But there are other considerations that I personally find disconcerting. The first one is electricity. It uses so much electricity, more than the entire country of Sweden or Argentina. And to me, I do actually care a little bit about the environment. So I just don't want to be part of that. It also, the logistics of logging in. Folks, you have a digital wallet, and it comes with a passcode, with a key. This is a true story. I have a friend of mine who, 12 years ago, when she was in college at NYU, wanted to buy something on a website that only accepted Bitcoin. So she bought like $150 worth of Bitcoin, and then ended up not buying it and just sat there. And then recently she found that computer, and she saw the digital wallet, and she kind of remembered what she did, and they did a quick computation based on what she paid on Bitcoins. Her worth today, the $150 in Bitcoin would be worth $81 million. $81 million. The thing is that she did not have the passkey. And you have 10 tries. After the 10th try, your account is locked up forever. You don't call your bank and say, hey, what's my password? No, it's locked up forever. And they had tried, her and her dad, 8 of those 10. They have 2 left. And what do you do? And it's not a singular story. In fact, a third of all Bitcoin today in circulation is estimated to be locked up. And perhaps the last consideration that would really discourage me from using Bitcoin is that countries, there's political risk with this and uncertainty, because China, for example, China is the place where about 2/3 of all these coins are being mined. What means mining? It basically means that in order for these transactions to be validated, there have to be some computers that validate and write up the transactions. And the way they get paid is by getting new Bitcoins. And a lot of this has happened in China. But recently, the government has really stepped up, not only by introducing their own digital currency to compete with Bitcoin, but to really start cracking down on these miners. And without this mining, it just exponentially harder to validate transactions. It takes a lot longer. And right now, again, it's a risk associated with Bitcoin. And to me, when you put it all together, if I want to have something that allows me to have a cocktail conversation, so be it. I spend money on worse thing. But right now, I don't look at this as saying, absolutely, you need to be part of the portfolio. I think it's more of the entertainment value for some of you on this call. That's the way I look at it.
Well, thank you very much, Apollo. We're right up on the hour here. So I have a follow-up question, which from someone in the audience, which I will send to you and get an answer from you. I know you're, another call coming up. So thank you very much for your time. We appreciate all the attendees for questions and thoughts. If you'd like to follow up, you can certainly follow up with Gigi or myself. Thank you very much.
Thanks for having me. Bye.
Thank you.